All right, welcome to this deep dive. And we're going to be diving into the stock market today. You're looking to, you want to really understand how it works,
Absolutely.
from the basics to the different ways of making money, whether it's, you want to get into long-term investing or jump into the fast-paced world of trading. um, we've got a great beginner's guide to work with here, plus
Here.
some extra insight so you can get up to speed quickly.
Yeah, and we'll make sure you come away with more than just a surface understanding, right?
Yeah.
We'll connect the dots, show you how the pieces fit together.
Okay, so let's start with the foundation. You already know the stock market is where company shares are bought and sold.
Right.
But what makes some stocks like soar while others plummet?
Yeah,
It can't just be random, right?
definitely not.
Yeah.
And, a lot of people, I think when for first starting out, they think the stock market is just reflecting what a company did yesterday.
Right.
But that's not really what's happening.
Uh-huh.
It's constantly trying to predict what's next, what their future earnings will be.
Oh.
Think about those early days of the internet.
Yeah.
Companies like Pets.com, they had huge valuations based on hype and potential.
Right.
But ultimately, their business model just wasn't sustainable.
So even if a company has a great track record, the market is more interested in its potential for growth and innovation.
Exactly. Like, look at Apple.
Yeah.
They've consistently delivered these innovative products. They've grown their market share.
Right.
And that's why their market cap, the total value of all their shares, has continued to climb. But that doesn't mean it's a straight line up.
Right.
Just think about how much Apple's valuation fluctuated even in the past year based on everything from supply chain issues to investor sentiment.
So it's a constant dance between like what's happening now and what investors believe will happen in the future. How does understanding this forward-looking nature help us make smarter decisions?
Yeah, so I think a great example of this is actually the 2009 economic recovery. A lot of people were hesitant to invest because unemployment was high, the economy looked bleak, but the stock market was already starting to climb because it was anticipating the eventual turnaround.
So if you waited till the economy was like obviously recovering, you would have missed out on some of the biggest gains.
Exactly. And that's why it's so important to do your research.
Yeah.
Try to understand, those underlying trends and factors
Right.
that are driving the market, not just react to headlines.
Don't just react to what you see.
Exactly.
Okay. So we've established that the stock market is this forward-looking beast.
Yes.
Let's say you're ready to buy your first stock. Like, how does that actually happen?
Right.
Do you, need to call up the company directly?
That would be fun, wouldn't it?
Yeah.
Hello, Apple. I'd like to buy a piece of your company.
Exactly.
But in reality, you need a brokerage account.
Right?
And think of it as like your gateway to the stock market. There are tons of options out there from, traditional brokers like Fidelity and Charles Schwab to online platforms like Robinhood.
So you open an account, transfer some funds, and then you can start buying and selling stocks.
Exactly.
Okay. What happens when you're ready to make a trade?
All right, so you've got two main options. You could use a market order or a limit order.
Okay.
A market order is basically saying, get me this stock at the best available price right now.
Right.
It's the fastest way to buy or sell.
But wouldn't that be risky, though? Couldn't the price, jump up in the time it takes for the order to go through?
It's definitely a possibility, especially with stocks that have, larger trading volume or liquidity.
Okay.
And that's where limit orders come in.
Okay.
With a limit order, you set the maximum price that you're willing to pay or the minimum price that you're willing to sell for.
So it's a bit more controlled.
Exactly.
You're saying, I'll buy at this price or better, but I won't chase the price up. But how do you know what price to set? What if you set it too low and miss out on the trade altogether?
Right. That's where understanding this thing called the bid-ask spread comes in.
Okay.
And it's basically the difference between the highest price a buyer is currently willing to pay, that's the bid,
Okay.
and the lowest price a seller is willing to accept, and that's the ask.
So if Microsoft's stock price is listed at $120, but the bid is $119.99 and the ask is $120.01, that 2-cent difference is the spread.
Exactly. And that spread can fluctuate rapidly, especially during volatile market conditions.
Okay.
But by understanding the bid-ask spread, you can set your limit orders strategically to increase your chances of getting filled at a price you're comfortable with.
So it's like you're playing this game of strategy, right?
Yeah.
You're trying to anticipate where the price might go and setting your orders accordingly.
Yeah,
I can see how limit orders would be a really good tool for managing risk.
absolutely.
Now let's shift gears a bit and talk about ETFs. I've heard a lot about indexing and how it can be a safer way to invest in the stock market.
Right.
Is that kind of like buying a prepackaged portfolio?
You're on the right track. An ETF, or exchange-traded fund, is like a basket of stocks that tracks a specific index.
Okay.
Like, for example, the S&P 500, which includes 500 of the largest U.S. companies. So instead of trying to pick individual winning stocks, you're essentially investing in a slice of the entire market.
So if you believe the overall market will go up in the long run, indexing could be a good way to like ride that wave.
Exactly.
What are the advantages of this approach?
But one of the biggest advantages is diversification. So instead of putting all your eggs in one basket,
Right.
you're spreading your risk across hundreds of companies.
Makes sense.
And because ETFs are passively managed, they typically have lower fees than actively managed mutual funds.
Okay.
And that can make a big difference in your returns over time.
So for someone who's new to investing and doesn't really have the time or expertise to research individual stocks, ETFs could be a good starting point.
Absolutely. But remember, even with indexing,
Yeah.
it's essential to understand the underlying index you're investing in and its potential risks and rewards.
Gotcha. Okay, so we've covered the basics of buying and selling individual stocks. We've explored the world of ETFs and indexing.
Right.
Let's move on to another popular approach, dividend investing.
Okay.
I've heard stories about people like building significant wealth through dividends, but how does that work exactly?
Yeah. So it all starts with understanding what a dividend is. Essentially, it's a portion of a company's profits that they distribute to their shareholders,
Okay.
typically on a quarterly basis. Think of it as like a little thank you gift for owning a piece of their company.
So you're getting paid just for holding on to the stock.
Exactly.
That sounds pretty appealing, especially if you're looking for a more passive way to generate income.
Right. And what's really powerful about dividends is the potential for compounding.
Okay.
So let's say you invest in a company that pays a consistent dividend. You can choose to reinvest those dividends, which means you're automatically buying more shares of the company.
And those additional shares then generate even more dividends, so it creates this snowball effect.
Precisely. And over time, that compounding effect can really significantly boost your returns.
Wow.
Of course, it's important to remember that dividends aren't guaranteed.
Right.
Companies can choose to reduce or even eliminate dividends if their profits decline.
So it's not just about chasing the highest dividend yield, but also about finding companies with a strong track record of paying dividends and a sustainable business model that's likely to generate profits in the future.
Exactly. And speaking of companies with a long history of paying dividends, have you heard of dividend aristocrats?
The name rings a bell, but refresh my memory.
Okay, so these are companies that have increased their dividends for at least 25 consecutive years.
Oh.
They're like the elite of the dividend-paying world.
So they're like the reliable old-timers of the stock market,
You could say that.
consistently rewarding their shareholders year after year.
Yeah, and if you're looking for a way to invest in a basket of dividend aristocrats, there's an ETF for that too.
No, of course there is.
The ProShares S&P 500 Dividend Aristocrats ETF. Ticker symbol, no BL.
Okay, so we've got ETFs covering a broad market index, like the S&P 500 with SPY.
Right.
And now we have no BL, which lets you invest in a group of these dividend aristocrats.
It seems like there's an ETF for everything these days.
There really is.
But what about investors who are looking for something more, like, exciting?
Okay, yeah.
More high growth potential?
So you're talking about growth stocks.
Yes.
These are companies that are expected to grow their revenues and earnings at a faster rate than the overall market.
Okay.
So think of companies like Tesla or Amazon in their early days,
Right.
disrupting industries and rapidly expanding their market share.
Those are the companies that everyone dreams of getting in on early, right?
Exactly.
But they often come with, like, higher price to earnings ratios or PE ratios.
Yeah.
Doesn't that mean they're overvalued? Not necessarily. Growth stocks often trade in higher PE ratios because investors are willing to pay a premium for that potential for future growth.
Okay.
They're betting on the company's ability to continue innovating and expanding its market dominance.
So it's all about the potential, not just the current performance.
Exactly.
But how do you identify these potential growth giants?
There's no foolproof formula, but there are some key indicators to look for.
Okay.
One is momentum.
Okay.
Growth stocks tend to exhibit strong upward price trends,
Mm-hmm.
often making new highs and staying above those key moving averages we talked about earlier.
So you're looking for stocks that are like breaking through resistance levels,
Yeah,
showing signs of continued upward movement.
exactly.
Okay.
And another important factor is market timing.
Right. Right.
Growth stocks tend to perform better in a bull market where the overall market is trending upwards. It's like having the wind at your back, pushing you forward.
So even the best growth stock might struggle if the overall market sentiment is negative.
That's right. It's all about understanding the interplay between individual company performance and those broader market trends.
This is all incredibly insightful, but before we go any further, I think it's time for us to take a quick break. We'll be right back with more of your deep dive into the stock market. Welcome back. We were just getting into the exciting world of growth stocks, but even with the most promising companies, there are risks involved, right?
Absolutely. And that's where risk management comes in. One of the most important tools for any trader, especially those focused on growth stocks, is the stop loss order.
Yeah, I've heard that term before, but honestly, it makes me a little nervous. It sounds like you're pre-planning for failure.
Not at all. It's more like setting a safety net. A stop loss order automatically sells your shares if the stock price drops to a certain level,
Okay.
limiting your potential losses. It takes emotion out of the equation and protects you from holding on to a losing position for too long.
So you're essentially saying, if this stock starts to tank, get me out before things get really bad. Does that mean you need to set a stop loss order for every trade?
It's a good rule of thumb, especially when you're dealing with those volatile growth stocks. And remember, it's not about being right or wrong. It's about protecting your capital and staying in the game for the long haul.
Okay, stop loss orders. A crucial tool in the risk management toolbox. What other strategies can help us navigate the ups and downs of the market?
One important concept to understand is scaling out. So instead of selling all your shares at once, you sell portions of your position at different price levels as the stock rises.
Oh, so you're locking in profits along the way and reducing your risk if the stock suddenly reverses course.
Exactly. It's like taking some chips off the table as you're winning a poker hand. It's a way to protect your gains and avoid getting greedy. Speaking of getting greedy, here's another golden rule of trading. Never add to a losing position.
So resist that temptation to buy the dip if the stock keeps falling. I can see how that could be a really slippery slope.
Yeah, it's one of the most common mistakes traders make. They get emotionally attached to a stock and try to average down their losses.
Right.
But it often just leads to even bigger losses. It's much better to cut your losses early and move on to other opportunities. There are always other fish in the sea, so to speak.
Speaking of other opportunities, let's talk about IPOs.
Okay.
I've heard stories of people making a fortune by getting in early on the next big thing, but I imagine there are risks involved as well.
Yeah. IPOs, or initial public offerings, are definitely exciting, but they're not for the faint of heart. It's when a private company decides to go public, offering shares to the public for the first time.
So it's like getting a chance to buy a slice of the pie before everyone else gets a taste.
That's a good way to put it, but remember, with IPOs, you're often dealing with limited information. The company's track record is often shorter, and their future prospects can be uncertain.
So it's a bit like venturing into uncharted territory. Are there certain things we should be aware of when considering an IPO investment?
Yeah, there are a few key factors to consider. One is the size of the float, which refers to the number of shares that are available for trading. A smaller float can lead to more volatility,
Oh, okay.
with prices swinging wildly up or down.
So it's like trying to navigate a choppy sea in a small boat.
Exactly. Another important factor is lockup expiration dates.
Okay.
So when a company goes public, insiders and early investors are typically restricted from selling their shares for a certain period, usually around 180 days.
So there's a temporary ban holding back a potential flood of shares. What happens when those lockup expirations hit?
It can create some selling pressure as those early investors cash out their profits. It's definitely something to be aware of and factor into your trading decisions.
Okay, IPOs. Exciting, but potentially risky. I'm starting to see why it's so important to do your homework and really understand the dynamics at play before jumping into any trade. What other common mistakes should we be wary of?
One of the biggest mistakes I see, especially with mass-like novice traders, is chasing 52-week lows thinking they're getting a bargain.
But isn't buying low and selling high the golden rule of investing?
It is, in theory,
Right.
but stocks often hit new lows for a reason.
Oh,
There might be fundamental problems with the company or the industry they're in, might be facing headwinds.
So it's not just about the price, it's about understanding the context and the reasons behind the price movement.
Exactly. Don't just blindly chase a low price without understanding why it's low. Another common mistake is getting caught up in the hype of penny stocks.
Those are the stocks that trade for less than $5 a share, right?
That's right.
They seem alluring because you can buy a lot of shares for a relatively small amount of money.
Yeah, but penny stocks are often associated with very small, speculative companies,
Hmm.
and they can be incredibly volatile. It's like gambling at a casino. You might get lucky, but the odds are stacked against you.
So it's best to focus on quality companies with a solid track record, even if it means buying fewer shares.
Exactly. It's about investing in businesses that you understand and believe in, not just chasing those quick profits.
What about short selling? I've heard that's a way to profit when stocks go down, but it seems incredibly risky.
It can be. Short selling involves borrowing shares of a stock, selling them at the current price, and then hoping to buy them back later at a lower price to return to the lender.
Okay.
If the stock goes up, you lose money.
So it's like betting against the house. You need to be very confident in your prediction for the stock to go down.
Exactly. And even if you're right about the direction, timing is everything.
Right.
Short squeezes can happen where a sudden surge in buying pressure forces short sellers to cover their positions, leading to a rapid price spike.
So short selling is definitely not for beginners. What about margin trading? I've heard that can amplify your returns, but it sounds like it could also amplify your losses.
That's exactly right. Margin trading involves borrowing money from your broker to buy more stock that you could afford with your own cash.
So it's like using leverage to boost your potential profits.
Right.
But what happens if the stock goes down?
Your losses are magnified. And if the stock drops below a certain level, you might get a margin call requiring you to deposit more funds into your account to cover the losses.
So margin trading can turn a small loss into a big problem very quickly.
Yeah.
It seems like it's best to avoid that till you've gained more experience and confidence in your trading abilities.
That's a wise approach. Another piece of advice I'd give to anyone new to the market is to avoid blindly following stock tips from friends, family, or those experts you see on social media.
So no matter how convincing that guy at the gym sounds, don't bet your retirement savings on his hot stock tip.
Exactly. It's essential to do your own research, understand the companies you're investing in, and develop your own investment strategy based on your goals and risk tolerance.
Okay, do your own homework. Don't fall for those get-rich-quick schemes. I'm sensing a theme here. Knowledge is power in the stock market.
Absolutely. The more you learn, the better equipped you'll be to make informed decisions and navigate the inevitable ups and downs of the market.
Speaking of knowledge, I'm curious, are there any insider secrets or less obvious things that you've learned over the years that you'd be willing to share?
Well, one of the most important lessons I've learned is that the market is driven as much by psychology as it is by fundamentals.
Oh, so it's not just about numbers on a spreadsheet. It's about understanding how people are reacting to those numbers and what that means for stock prices.
Exactly. Market psychology is all about understanding how fear, greed, and other emotions can drive market trends.
Are there any specific ways we can apply this understanding of market psychology to our trading decisions?
Yeah, one example is paying attention to how the market reacts to news and events. So let's say a company releases a positive earnings report, but their stock price drops.
That seems kind of counterintuitive. Why would the stock go down on good news?
It could be that the market was already expecting even better results, or there might be other concerns that outweigh the positive news.
Oh.
The point is the market's reaction, or lack thereof, can tell you a lot about investor sentiment.
So it's like reading between the lines, trying to decipher the market's emotional state.
That's a good way to think about it. Another aspect of market psychology is understand the role of momentum. So stocks that are trending upwards tend to attract more buyers, creating a self-fulfilling prophecy.
Oh, so success breeds success.
In a way, yes. And conversely, stocks that are trending downwards often attract more sellers, creating a downward spiral.
This all makes sense, but I have to ask, is it really possible to time the market perfectly? I've heard that's a fool's errand.
You're right. Trying to predict the exact top or bottom of the market is nearly impossible.
Right.
But there are certain seasonal patterns that can inform our trading decisions.
I've heard the saying, sell in May and go away. Is there any truth to that?
Yeah, it's an old adage that's based on the historical tendency for the stock market to perform better from November through April,
Okay.
compared to the May through October
But
period.
it's not a guarantee, but there's some statistical evidence to support it.
Exactly. Of
Yeah.
course, past performance is never a guarantee of future results, but it's something to be aware of as you develop your trading strategy.
Okay, seasonal patterns. Another piece of the puzzle. Any other nuggets of wisdom you've picked up along the way?
Here's one that served me well. Focus on companies that are leaders in their industries, those with the highest sales within their sector. Think about companies like Home Depot for home improvement, McDonald's for fast food, or Visa for payments.
So it's about identifying the dominant players, the ones with a proven track record of success and a strong competitive moat. What's the rationale behind that approach?
These companies often have strong brand recognition, economies of scale, and a loyal customer base,
Right.
which gives them an edge in their respective markets. They're the ones that are most likely to weather those economic storms and continue growing over the long term.
So it's like betting on the thoroughbreds, the ones with the best pedigree and the highest probability of winning the race.
That's a good analogy. It's not about picking every winner, but it's about tilting the odds in your favor by focusing on companies with a demonstrated ability to execute and generate profits.
This is all incredibly helpful, but I'm curious, have you ever come across any strategies or insights that initially seemed counterintuitive, but turned out to be surprisingly effective?
One thing I've observed over the years is that markets often behave contrary to what the majority of experts are predicting.
So if everyone's bullish and expecting the market to go up, that might actually be a sign that it's time to be cautious.
It can be. Remember, the market is always trying to discount the future. If everyone is already expecting a certain outcome, it's likely already priced into the market.
So it's about looking for those contrarian signals, those moments when the crowd might be getting it wrong.
Exactly. It's not about blindly going against the grain, but it's about being aware of that herd mentality and considering alternative perspectives.
That's a powerful insight. It seems like the key to success in the stock market is to constantly be learning, adapting, and refining your approach. Would you agree?
Absolutely. The market is constantly evolving, and what worked yesterday might not work tomorrow. The most successful traders are the ones who are constantly seeking new knowledge, testing new strategies, and adapting to those changing market conditions.
Speaking of seeking new knowledge, I'd love to hear about any books, resources, or mentors that have been particularly influential in your trading journey.
One of the most valuable things I've learned is the importance of studying the greats, those who have achieved that extraordinary success in the market. Reading their books and learning from their experiences can provide some invaluable insights.
Who are some of the traders you've learned the most from?
Oh, there are so many, but a few that come to mind are George Soros, known for his bold bets and understanding of market psychology, Warren Buffett, the master of value investing and long-term thinking, and Ed Seykota, a pioneer in trend following and system development.
Those are some legendary names in the trading world. What specific lessons have you taken away from their work?
One of the most important lessons I've learned is the importance of risk management.
Hmm.
Soros famously said, "It's not whether you're right or wrong that's important, but how much money you make when you're right and how much you lose when you're wrong."
Mm-hmm.
That quote has really stuck with me throughout my trading career.
So it's not about being right all the time. It's about managing your risk so that even when you're wrong, it doesn't wipe you out.
Exactly. And from Buffett, I've learned the importance of patience and discipline. He often says, the stock market is a device for transferring money from the impatient to the patient.
Right.
It's a reminder that investing is a marathon, not a sprint.
So resist the urge to chase those quick profits and focus on building wealth slowly and steadily over time. What about Ed Seykota? What insights have you gleaned from his work?
Seykota is a big proponent of trend following, which essentially means riding the wave of an established trend, whether it's up or down. He believes in letting your winners run and cutting your losers short.
So it's about identifying the prevailing trend and aligning your trades with that trend rather than trying to fight it.
Exactly. And he emphasizes the importance of having a systematic approach, a set of rules that you follow consistently, regardless of your emotions or opinions.
So it's about taking the subjectivity out of trading and following a predetermined plan. I can see how that could be really helpful in avoiding those impulsive decisions.
It's one of the keys to achieving consistent results in the market. And speaking of consistency, another important lesson I've learned is that the market is always right.
That sounds like a pretty bold statement. What do you mean by that?
I mean that the price of a stock reflects all available information at any given moment. Even if you disagree with the market's assessment, it's futile to fight it.
So instead of trying to outsmart the market, we should strive to understand it and align our trades with its direction.
Exactly. It's about recognizing that you're not smarter than the collective wisdom of millions of investors who are constantly buying and selling stocks.
Okay, the market is always right. A humbling thought. I'm starting to see how trading is as much about psychology and self-awareness as it is about technical analysis and financial knowledge.
You're absolutely right. Success in the market requires not only understanding how the market works, but also understanding yourself, your strengths, your weaknesses, and your emotional triggers.
This has been an incredibly insightful conversation, but before we wrap up this section, I'd love to hear any final thoughts or pieces of advice you'd like to share with our listener as they embark on their own trading journey.
You know, one of the most common questions I get from new traders is, what's the best trading strategy? And my answer is always the same. The best strategy is the one that works for you.
So there's no one-size-fits-all approach.
Exactly. What works for one trader might not work for another. It depends on your personality, your risk tolerance, your time commitment, and your trading goals.
So it's about finding a strategy that aligns with your individual circumstances and preferences.
Exactly. And it's about being willing to experiment, to test different approaches, and to find what works best for you. Trading is a journey of self-discovery, and the more you learn about yourself and the market, the more successful you'll become.
This has been an incredible deep dive into the world of trading. But before we move on to the final section, let's take a quick break. We'll be right back with more insights and advice to help you navigate the stock market with confidence. Welcome back to your deep dive into the stock market. We've covered a lot of ground, from the basics of buying and selling stocks to exploring different trading strategies
Right.
and the importance of risk management. And we even talked about the psychology of trading, how understanding like market sentiment
Yeah.
and managing your own emotions can be just as important as the technical analysis.
All connected.
Yeah. And we also talked about how important it is to just never stop learning, study the greats, and adapt to those ever-changing market conditions. But before we wrap up this deep dive, I wanted to revisit those inspiring quotes from those legendary traders that you mentioned earlier.
Yeah, those pearls of wisdom.
Yeah.
They've guided many successful traders over the years.
Yeah, I found them incredibly insightful, like a great reminder of those principles that really underpin successful trading.
Yeah, they really encapsulate the mindset and approach that can help you not just survive, but thrive in the market.
Do you mind sharing a few of those quotes again and maybe expanding on what they mean to you personally?
Sure, one of my favorites is from George Soros. He said, "The financial markets generally are unpredictable. So that one has to have different scenarios. The idea that you can actually predict what's going to happen contradicts my way of looking at the market."
And that really resonates with what we were discussing earlier about, how the market is driven as much by psychology and these unpredictable events
Right.
as by the fundamentals.
Yeah, it's a reminder to be humble, to recognize that we can't predict the future with certainty,
Right.
and to always be prepared for the unexpected.
So instead of trying to predict the future, we should just focus on understanding the present
Yeah,
and managing our risk accordingly.
exactly. Another quote that has stuck with me is from Warren Buffett. He said, "Risk comes from not knowing what you're doing."
So knowledge is the antidote to risk.
In a way, yes.
Yeah.
The more you understand about the market,
Right.
the companies you're investing in,
Uh-huh.
and the strategies you're using, the better equipped you'll be to manage risk effectively.
That makes sense. Any other quotes that have really shaped your trading philosophy?
Yeah, one more from Ed Seykota. He said, "Systems don't need to be changed. The trick is for a trader to develop a system with which he is compatible."
So that speaks to the importance of, finding a trading style that aligns with your personality, your strengths, and your risk tolerance.
Exactly. It's not about finding the holy grail of trading systems, but rather about finding a system that you understand,
Right.
believe in, and can execute consistently.
This has been such a valuable deep dive. I feel like I've not only gained knowledge, but a deeper understanding of the mindset
Right.
and the principles that really underpin successful trading.
It's been a pleasure sharing these insights with you. And remember, the journey doesn't end here. The stock market is a lifelong learning experience.
So to our listener out there, we encourage you to continue exploring, experimenting, and refining your approach to the market.
Yeah, keep learning, keep growing.
And remember, as you embark on your own trading journey, the most important asset you have is your own mind.
Couldn't agree more.
Develop a sound trading plan.
Absolutely.
manage your risk wisely,
Yes,
and never stop learning. Well, that's it for this deep dive into the stock market. We hope you found it valuable and insightful.
we did too.
Until next time.